In this video, I'm going to talk about what the Dow Theory is. So the Dow Theory attempts to identify trend reversals. Why is this important? If you can identify a reversal before it happens, you can exit the market and prevent yourself from losing money. But not only can you prevent yourself from losing money, you can actually profit by shorting the market. So in case you don't know what shorting is, it's profiting when the market goes down. As opposed to buying first and selling later, basically you sell first at the higher price and then you buy when the price goes lower, so you're profiting the difference. The Dow Theory is a trigger letting you know the market is turning when a specific set of events occur. Statistically speaking, losses do occur at times since the Dow Theory occasionally triggers false signals, but they are quite rare compared to the number of accurate signals. So here's an example with a buy and hold. If an investor purchased one share of the Dow Jones Index at $44 in 1897, he or she could have cashed out in January 1990 for $2,500. That's basically buying and holding for about 100 years. However, if that investor had reversed their position with every sell signal and repurchased the Dow at every buy signal, that $44 would have been worth over $51,000. You can see that the Dow Theory outperforms the buy and hold strategy by a wide margin. So in order to understand when the market is likely to turn, we have to understand the three types of trends according to the Dow Theory. Number one is the primary, number two is the secondary, and number three is the minor trend. Let's talk about the primary trend first. So this is an oversimplification of what a primary trend looks like. The primary trend tends to be intact for at least a year or two, sometimes a few years, but according to the Dow Theory, it's a minimum of 9 months. Anything shorter than that would be considered a secondary trend. Generally speaking, the primary trend moves with the business cycle. As the economy expands, the primary trend in the stock market goes into a bull market. And as the economy goes into a recession, the primary trend moves into a bear market. Let's look at some primary trend examples in recent history. This is a chart of the Dow Jones from 1993 to 2015. During the tech boom, the stock market had one of the biggest bull markets in history. It eventually turned into a bubble and it peaked in 2000. You may have heard of the dot-com bubble or the tech bubble of the 90s. The business cycle reversed for a couple of years, which is why the market went down here. After the market bottomed, we had the real estate boom, which started the next primary uptrend, followed by the financial crisis, which of course precipitated the primary downtrend. So those are primary trends. Before I can talk about how to buy and sell using the Dow Theory, we have to explore secondary and minor trends, because these trends often cause a lot of head fakes. They tend to sucker people into thinking that the trend is changing, when in reality, it's just traders panicking a little bit. Within the primary trend, there's what they call market corrections, which is a form of a secondary or minor trend. A secondary trend's duration is often between 6 weeks to 9 months, and it runs in the opposite direction of the primary trend. These secondary trends tend to be knee-jerk reactions, and they're emotional and reactive to negative news. It's theorized that as the primary trend moves too far ahead of itself, a correction is needed to bring the market back down to equilibrium. And it's often precipitated by such things as threat of war, interest rate changes, catastrophes, scandals, those kind of things. In my experience, these counter trends are very difficult to forecast. Each one of them differ in terms of character and magnitude and duration, which is why I tend to avoid it from a trading point of view. And you'll also find that the overwhelming majority of big-name professional traders employ trend trading, and they stay away from counter-trend trading because it's usually a little bit difficult to forecast. So the last movement we're going to talk about is the minor trend. For the purpose of this video, minor trends aren't all that important. They are important for day trading, which we'll definitely cover in a future video, so I don't want to spend too much time talking about it now, but These trends last anywhere from a few days up to about 6 weeks, and they're often referred to as noise. They tend to be random at times or caused by brute force among institutions that are buying or selling large amounts for whatever reason. Think of secondary trends operating within a primary trend and a minor trend operating within a secondary trend. All right, that's it for this video. In the next video, we're going to go into specifics about how to buy and sell the Dow Theory and where to place your orders. If you're new here, please like and subscribe so that you'll get all the updates in the future. Thanks for watching.